Sandeep Bhatia as well from Kotak joins in on board. Sandeep, hi, morning. What's the sense that you're getting about the market? Because the last few days of volatility clearly seems to be indicating that perhaps 6,400 was the ceiling in the near term.
Yes, I think the kind of run that we saw in November, first half of December is not something which the market is seeing now in January. Clearly, there are events which are going to have an impact on the market. The first is the fact that by the end of this month, we'll have the RBI announcing its rate. We are talking about no increase in rates, so the policy rates to remain stable. But it's still not clear whether we will see a decline in policy rates coming through in the first 4 or 5 months of this year. At least our view is that the rates that RBI wants to maintain are going to be high and elevated until we see some sort of a stable government come through at the center and also some inflation to roll down. So eventually for the market to have a big trigger, it will just be some earnings numbers which will come through from mid-Jan onwards. But even there, I think it's a mixed picture. We are looking at 11 to 13% kind of YOY earnings growth. So we have to pick and choose. I think overall 2014 is a still bottom-up stock picking market. It's still not a big thematic market which will move up across the board.
Sandeep, the theme for 2013 has been quality, quality and quality. For those who bought into IT, pharma, quality mid-cap stocks, they've had a good year. Do you think that theme will extend to 2014 as well? Will the quality theme roll over to this year also?
It depends upon where we see the politics to play out. So I think there is clearly going to be an expectation of stable government coming through in 2014, April, May, June. We'll soon have the announcements of the dates of the elections for polling. But our view is that essentially there could be a bit of a hope trade coming through in Feb, March, April. Let's get this result season behind us. After that, I think events in India will move, focus will move entirely towards politics, and there could be a hope trade coming through. At that point in time, low quality stocks could see a rise. Whether this would be a trading rally depends on whether we see a good outcome, a stable outcome in terms of a government in the elections, or we see those hopes fade away. But I think there could be a bit of a hope trade in the second month onwards in India.
Where would that hope rally then take us? Another 5% from here, or would it be a significant move up?
I think the big heavyweights in terms of the index is not where the hope trade will play out. It will probably play out in the second tier names. We've seen parts of that happening in the fourth quarter of last calendar year. We could see that also come through in the first quarter and the first April-May part of this current year. So it's not necessarily an index kind of a move. It will mostly be some kind of a move where people take a bet that a new government is going to change the complexion of the economy. Even if that takes 2 years in the making, some of these stocks will rally ahead of that.
Sandeep, I'm with you when you say that the big game-changing event for 2014, locally at least, is election. But elections are due in May. What happens to market in the run-up to the election?
So, okay, I mean, to say what happens to the market, we have to construct a scenario. So the basic scenario is that rates remain high. If we see an improvement in inflation, or rather I would say falling of inflation, then clearly there is some kind of a interest rate trade happening. So we could look at some of the auto names which will benefit from falling interest rates on hopes of stronger auto volume sales this year. Or we could see some kind of a hope happening through NBFCs if the rates come off. But if we don't see that, and our base view is that we don't see a big decline in interest rates, then the market essentially on the headline front focuses on large quality names, as you mentioned, whether it's tech or some of the good pharma export plays that the market is focused on. But I think most of the money will be made outside these big names and it will be in the second tier name. So I think the market remains range bound, but there are clearly interesting moves happening below the market.
Let me challenge your conviction on autos. Why should autos do well? Because autos have done relatively well in 2013. If you are of the view that economy will bounce back, this time the economic recovery would be investment-led, it will not be consumption-led. And if I look at the valuations for most of the auto stocks, none of the key top-line auto stocks are cheap.
I think you have some elements of truth in what you have just mentioned. One should remember when the economic recovery takes place, it's not going to be a on-off switch. That is that today there is an economic recovery which was not there yesterday. So it's going to be a slow burn in terms of the momentum, in terms of confidence. The fact is that today most people have decided not to spend on projects even if they get approvals because they want to have clarity come through. And once you see some clarity come through in terms of the government, and even if you start spending, it is not until the end of the year that we actually start some benefit of that flowing through in terms of top line growth or GDP. And any capex which is done today actually produces revenue 2 years down the road. So the revenues and earnings trajectory is driven by businesses which are already set to benefit if there is an economic rebound immediately, where they don't have to invest large sums of money, where they don't have to wait for the kick through to come through because capacities are already in place. So that's one reason why autos to some extent is much better. The margin uptake on a volume growth on a operating leverage business in autos, especially in Tata Motors, where the domestic business has been written off by everybody, can be very huge. We like Tata Motors more than any other stock, primarily because it's currently an export business, but it can become a domestic business by the end of this year. So that's why autos come through. There are specific, reasons why some of these names react faster to an economic turnaround than the capex-driven names that you have been asking about.
Well, big block deal on MCX in just the last few seconds or so on the BSE. And remember, the SEBI has also approved the appointment of the new MD and CEO. The board has also okayed a 1:1 rights issue in case of MCX SX. That's the block deal and that's the price level. 577.55 is where the stock is right now. Sandeep, I don't know if you track this one, but post the Cleanup Act, would names like MCX interest you?
No, we don't cover such names, but clearly I think these are event-driven trades. It's difficult for any mainstream brokerage to call events or anyone to call any events. So any trader who wants to play that will have to be conscious of the fact that depending upon who takes over and what event and how things move after that change, the stock can be a good performer or lackluster. So these are event-driven trades. It's difficult for us to make comments.
Point. Let's talk about earnings, because come Friday and Infi would be kickstarting the earnings. For the Sensex EPS for FY15, what is it that you're expecting, both on a worst case scenario and the best case scenario when it comes to earnings?
You know, the Sensex is a very narrow universe of stocks, but of course everyone talks about it because it's a headline index. And not only that, it is an easy comparable index because if you know the earnings of 30 stocks, you think you know the earnings of the entire market. Anyway, for the sake of answering your question, it's a 13% earnings growth at the max that we expect. Earnings growth will be driven by the automobile sector and by the IT sector. So these are the two strong contributors to earnings. The weak earnings, if that happens, will be for the NPAs coming through the banking system. So bank stocks are a large portion of all indices and also for BSE. So if there is the downslide and big NPA recognition by some of these banks, large banks, then the earnings growth could be in high single digits between 7 to 8%. So that's the worst case for Sensex earnings. But of course, you have to remember that this is driven by the banking sector, and the NPA recognition of the banking sector is something which is impacting this. So it's not a quarterly phenomena. I think the banking sector needs to get a lot of its NPA in the book, and that's something which will hit earnings over the next 12 months. I think there's also a focus coming from RBI to align the books of all banks at certain basic recognition of NPAs. So combination of these factors mean that bank earnings will be under pressure. So to that extent, reported headline earnings of Sensex will be coming under pressure, but it will primarily be due to one sector.
Fair point. Let's stay with IT because that's where the expectations are high, that's where performance is there, that's where the real momentum is. Now, most of the large cap IT companies, they came out with absolutely blowout set of Q2 numbers because a falling rupee or strengthening dollar really aided their margins. Do you think this time around, courtesy currency volatility, we could be in for a result disappointment?
Most of these businesses have longer term hedges, so near term, short term volatility does not immediately play out in their numbers. It could have an impact if some of them close large, trades and book large, revenues or hedges at some of the, adverse or unfavorable currency during a volatility period. But I don't think that's something which is going to impact the headline names which are going to report. So to that extent, we expect, and also with IT, one has to remember that at least with Infosys, valuations are in favor of Infosys vis-a-vis TCS. And also we have a period where the underlying volume growth trajectory for the entire business is moving up because the US is coming back stronger. And to that extent, that's something which is a more structural reason for favoring IT earnings rather than any currency hedge, which has already played out and is already part of base earnings for most analysts. The incremental delta will come through from better volume growth and better than expected pricing numbers which the business can get.
Sandeep, as a house, what is your tactical view on PSU banks? Because PSU banks have managed to bounce back. So if your assumption is that the economy will come back, rates will come down, is there a tactical trade in PSU banks? Because the biggest beneficiary of an economic comeback or a falling interest rate is PSU banks, which will report good numbers because of treasury income.
Our view on PSU banks is that we remain underweight right now. As I mentioned, we expect the rates to remain at elevated but steady levels right now till at least the elections, till May, June. After that, we'll have to look at whether we see a roll down in terms of policy rates, and therefore also on 10-year bond yields we see a decline. So in the near term, I think the pressure will be on earnings as far as PSU banks is concerned. In fact, structurally for the next 2 years, there's going to be a lot of pressure to clean up the balance sheets. Especially if the economy recovers, there's going to be some more pressure to get everyone aligned. In the near term, at least, we would avoid PSU banks.
What about NBFCs? Of late, some of the names have been showing traction from the mid-cap arena, of course. Anything that interests you there?
No, I think NBFCs generally have weaker balance sheets than most of the large PSU banks. So to that extent, just wait. I think there could be tactical plays if we see a roll down of policy rates coming through, which we expect after April, May. So not now, not in the near term for NBFCs.
Well, Sandeep, appreciate your time and thank you for joining us.